The Greek tragedy seems to be entering its next act. While European politicians and the European Central Bank desperately try to avoid a Greek bankruptcy, the markets are nervous at the outcome of all of the initiatives. We asked Giles Keating, head of global research, to shed some light on the situation. Giles, you've just come out of the Global Economic and Strategy Group meeting. What is Credit Suisse's position on the Greek crisis?
I'd say we're cautiously optimistic. We think the chance of a disorderly default over the coming months is unlikely. Of course, we're aware of the longer-term problems, but we think the political momentum to try and find a solution is very strong. And I think, although the situation does change, I think that has to be said by the day, if not by the hour, so one can never be absolutely sure, but it does seem at the time of making this recording to be going the right direction.
There's some discrepancy among the most important European leaders about financing this huge debt. What's at the heart of this dilemma?
Well, clearly we did see the German position initially was wanting to have very strong private sector involvement. In other words, some of the banks that hold the debt, rolling that over on a more or less obligatory basis. But very, very importantly, at a meeting between Chancellor Merkel and President Sarkozy of France, we saw that difference being resolved. And France and Germany now seem to be going along the same direction in agreeing that whatever the involvement of the private sector, it must not be of some kind of compulsory nature that triggers a default.
Greece needs the injection of the next tranche of 12 billion euro by mid-July. Is it likely that a compromise will be found?
I think all we can say is that at the time of recording, there is so much steps that have been taken in that direction. I mentioned the agreement between France and Germany. I think we could add to that that we saw a reshuffle in Greece, which brought in more key members of the ruling party, which seems to strengthen the government's position, although before we can be absolutely sure, we have to see the result of further votes, which were not available at the time we made the call. So I think there are many steps, but we are seeming to move the right way. And so, although it looks as though the timing is tight, I think it looks as though that money can be dispersed on time.
Another threat comes from within Greece itself, where protests against the austerity measures are getting stronger. Could Greece provoke its own bankruptcy?
Well, I actually personally do not think it's at all in Greece's interest to have a bankruptcy. If Greece were to default on the debt, it would lose access to the various sources of money from the IMF and from Europe. And since Greece still runs a large government deficit, that would mean that the government suddenly no longer had adequate funding for civil servants and all sorts of other current spending, and so would overnight have to introduce some pretty drastic cutbacks. And you know, that's the same for any kind of a debtor that's getting extra money from its creditors. Now, because of that, I think it's actually unlikely that Greece would move unilaterally in this direction. But you can never be sure, because of course, politics in any country can go in unexpected directions, and of course, people in Greece, quite understandably, are feeling the pain. So it's a judgment which seems to point against any kind of unilateral action to default, but we cannot be absolutely sure.
What would the consequences be of a bankruptcy on the euro?
Again, we can't be sure, but it looks as though it would not be good. The problem, of course, is that some kind of default would lead to a spillover to losses not only for Greek banks, which hold a lot of the debt, but also for French banks, German banks, as well as for the ECB itself, not to mention the IMF, and to a lesser extent, banks spread around elsewhere in Europe and the States. And so all of these effects could damage the capital position of those banks. And again, I think that could produce a very negative market reaction. It could be that remedial steps, perhaps to recapitalize the banks, could be taken. But again, that would have to happen very rapidly. And of course, we don't quite know whether the CDS, the credit default swap market, would be able to take the strain of the settlement. So there are just lots of unknowns. I think that's the problem.
Has the Greek tragedy monopolized the discussions within the Global Economic and Strategy Group meeting, or did you find time to discuss other topics?
Of course, in the GESG, we also focused very much on the current state of the global economic cycle. Some of the data, particularly out of the US, have been a bit weak recently. And people are also worried about slowing down in China and elsewhere. I think the view of the GESG was very, very much that we feel that these are temporary slowdown effects, and we do actually expect a significant, perhaps really quite substantial re-acceleration of growth in the second half of the year. For example, we note that US corporations have the highest level of cash relative to balance sheet for 55 years. We notice that in China, really the slowdown story is about the last 6 months. And it looks as though some of the indicators are now actually flattening out there and so ready to move up. And we're certainly seeing some stabilization of base metal, industrial metals prices, which points the same way. So overall, I think we felt pretty confident that we will see stronger economic data, if not for 1 month, then certainly looking ahead 2-3 months. And that, of course, is very good news for continued recovery. It's good news for underpinning stock markets and so on.
What do investors have to consider in the current economic climate?
Well, the Credit Suisse Investment Committee, which very much uses the GESG input, has already indicated that it is looking for a point to raise its allocation to equities again. And I think investors should really follow that lead. And at the point where the investment committee does make that move, I think that would be a signal to increase equity exposures with a particular focus on emerging markets, and within that, a focus on China. And among the developed markets, to perhaps focus a little bit more on the US, where there's very strong earnings momentum in the stock markets. And meanwhile, to be cautious about in the bond markets, not to have long duration bonds, because yields have fallen and we think they can go back up if we do indeed get the better economic data and we do indeed see that the Greece crisis being at least partially resolved. So I think these are some of the major recommendations that we would make.